All right, so good evening and welcome to the session today and our final, you know, revision crash course session as we try to wrap up for the examination coming up tomorrow, 9 a.m. for financial reporting students, and then um, 2 p.m. for corporate reporting students. And we want to use this session as, just a way to help us walk through the syllabus and the various things that we have to pay attention to. We are also live on YouTube, so for those of you joining us on YouTube, if there is any questions you have, you put it in the comment section for me. Um, no, chat box for me if you're on the live call. And for those of you joining us on the live stream also, if there are any questions, you're gonna raise your hand. I bring you up, or you put it in the chat for me. What I want to do in this discussion is to try as much as possible and walk you through the syllabus, focusing on some basic principles that we need to really be mindful of, revisit as we get ourselves excited for the examination tomorrow. So before I get myself excited into the main discussion, what I want to do shortly is to find out if there is any specific question that you have. Remember, we are not going to have time to do any lengthy thing. So if there is any specific question you have, something that you would want me to share my thought on, for those of you joining us on YouTube, you can put it in the chat for me. If you are on the Zoom call with me, you can raise your hand. I'll bring you up, or you put it in the chat for me. So something specific that you would want me to share my thought on, you can raise your hand. I bring you up for the Zoom people. And for those of you watching us on YouTube, you can put it in the chat for me, and I'll be excited to provide you with some answers as well. So let's see if I can have some questions briefly. Like I said, as specific as possible to help us in that particular case, because we don't really have time to talk about anything lengthy. You have to be specific. You cut the chase straight to the point to allow for us to be able to address a lot of questions from everyone as much as possible, so that we can all be in a position to be able to pass the examination. I'm hoping that it's going to be an interactive session, but it's going to be an intense session that is going to do a lot of great for you as you go into the exam hall tomorrow. And so let's see what I have here. What is this? This is Tinashi Maru, who said, "Good evening, sir. Good evening, Tinashi." That is on YouTube, I think so. Okay, so let's see. Yes, Benjamin, your hand is up.
Sir, good evening.
Yeah, good evening. Yes, good evening.
Okay, I said a question under ratio. That was the question that you gave us as a assignment. The last assignment on ratios. And then the question is highlight 5 areas which would require further investigation, including reference to other pieces of information which would complement your analysis of the performance of Tequila Ghana Limited. So if you can throw light on that one for me.
Now, that is based on the context of the analysis that you did. So, the analysis that you did, the five key areas that you identified as issues in the question that you feel the entity must investigate. So there are a lot of issues that can come up here as issues that we would have to look out for or investigate. Number one, they are trade payable days. Some people mention that the entity must investigate that. The context of that question is based on the analysis that you did. So in the analysis, we saw that their revenue fell in the current year 2019 under review. Then we saw that their profitability ratios, apart from the gross profit margin, the net asset turnover, the net profit margin, and the ROSI, all these ratios were declining or were reducing in the current year. So, what are the areas that you have to look out for or that need further investigation? It depends on the context of the question and the issues that you have identified as challenges for the entity in the question. So, in the context of that question, yes, the profitability issues are things that we may have to investigate. Number two, we saw that their inventory holding days was increasing in the current year. That could be something that the entity must investigate on, because why are they having a higher inventory holding days? Does it mean that there are some slow moving inventories that need to be removed from the inventory of the organization? That's an issue. Then we also saw that their trade receivable days was increasing or was higher in the current year than it was in the previous year. So again, that means that the trade receivable days, why it is going up, although the revenue of the company was reducing. Why is that? Because really, if your trade receivable days is going up, you expect revenue to also go up, which means, oh, you are selling a lot on credit, but your revenue came down, but the trade receivable days went up. That requires investigation. So the profitability situation, the inventory situation, the trade receivable situation, all these require investigation in that particular case. Then somebody can also talk about the trade payable days. It was also rising marginally or a little. That is also an area that could cause for investigation. Then the interest cover ratio, it was 8 point something, it came to 5.5. Yes, it is still significant, but why did it reduce? We would have to investigate that as well in that particular case. So the context of that question is dependent on the key issues that you identified in the question, which the entity must look into in order to deal with the challenges that they have as you have identified in your analysis. So revenue, profitability, inventory holding period, trade receivables, trade payables, the interest cover, all these are areas that we can say that they have to look into, because all these ratios were not as high as possible, or they were deteriorating in the current year as compared to the previous year. So questions of that nature, it is dependent on the context of the challenges that you have identified in your analysis, which the examiner is just asking you to repeat and then make suggestions as to what has to be done. So that is the context to that particular question in that case. Any other questions for me? Like I said, something specific that you want to pick my brain on. Those of you on the Zoom, you can raise your hand, I'll bring you up. Okay. All right. Or you put it in the chat for me. Those of you watching us on YouTube, you can put it in the chat for me, and I'll be excited to answer them for you. So anything specifically that you have that you want me to pick my brain, you want to pick my brain on quickly before I get excited, I want to do that quickly. So if there are any other questions for me, you can raise your hand, I'll bring you up, or put it in the chat for me. So then please say the volume is low. I don't know, my volume is not supposed to be low, so probably check your device in that case. Please walk us through financial instruments. I cannot do that. So if there is something specific in financial instrument that you want me to talk about, I will talk about it, because I can't teach the whole financial instrument at this point. So if there is something specific in financial instrument that you want me to talk about, fine. But I can't teach the whole financial instrument now. So you got to be specific for me. Please, can you assist to solve question 3A, lease question in? I'm sorry, I can't solve any question at this time. It's a past question, like you have said. November 2023 corporate reporting. I guess the solution is available in the question. So if there is any specific question you have for me under leases, you can throw it at me, but I am not solving any questions for you at this point. Okay, so something specific, then I can take you through. But solving a question, I'm sorry, but I cannot do that. Unfortunately, I cannot do that. Okay. Any other thing for me, or we good? Then I can get excited into my discussion. If there are no specific issues, then I can get excited into my discussion there. I said, give us executive summary on sale and leaseback. I don't know what you mean by executive summary. I think I'll talk about that later on in my discussion, so you stay tuned. I'm going to be bringing that up later on in my discussion, so stay tuned, Paul. I'm going to be covering that. Yes, Akins, your hand is up.
Yes, thank you very much, and have a good evening. I want you to address the sale and leaseback where it meets the IFRS 15. That's contract with customers.
Like I said,
There's a
I'll be talking about the sale and leaseback discussion later on in the
okay.
discussion, so you stay tuned and I'll be covering that as we go on.
Thank you.
All right. What else? Nothing else? Okay. So, let's get excited. I'm going to try to spend some time to walk you through the syllabus. Okay? So, we're going to walk through the syllabus and try to walk you through some of the principles, some of the key issues that you have to look out for, and the way a couple of things has to be treated. And so what is going to be happening is that as I proceed with the discussion of these principles, if there is anything that you need clarity on, those of you with me on Zoom, you can raise your hand and bring you up, or you can put it in the chat for me. And then those of you watching me on YouTube also, you can raise your hand and bring you up. So we're going to walk in from question 1, question 2, question 3, question 4, and question 5, both in corporate reporting and financial reporting. So it's going to be interesting. I'm going to try as much as possible and see if we can do that in the next possibly 45 minutes ish, plus addressing your questions. Does that make sense? So let's see how we can walk through the syllabus and the few things that we have to pay attention to. So let me bring up my slide quickly and let's see what we got. Those of you watching on YouTube, please consider to share the video and let's get many people joining the stream like this so we can help a lot of students writing the exam tomorrow. So you can consider sharing the broadcast. That it's going to help us a lot to reach a lot of people. Okay, so let's go. Question 1. Question 1 is going to be on consolidated financial statements. For the most part, we expect this to be 20 marks, right? 20 marks. As I've told you already in class, my recommendation is that this should be your last but one question. Let me say that again. I don't care how smart you think you are, but I forbid you and recommend to you to stay away from the consolidated financial statement question. Let that be your last but one question, and the focus is the easy marks that you can get on the overall. That's my recommendation. Now, that doesn't mean if you go to the exam and something comes over you and you are like, uh-oh, I want to answer the consolidation question first. I got you. You can do that. But let me tell you that there is a 90% chance that you're going to fail the exam if you start with a consolidated financial statement question. There's a 90% chance that you're going to fail the exam if you start with a consolidated financial statement question. I'm not the one saying this. This is the chief examiner's report. Per the chief examiner's report, many students do well in the consolidated financial statement question because that is the question they answer first, but they end up failing the exam because consolidation will always have something under its sleeve that will cause you to use more than the 36 minutes you are supposed to use. So to keep it cool, my recommendation is stay away from it, at least in the beginning. Let that be your last or last but one-ish, and you are coming in from the easy marks or for the easy marks. Does that make sense? So that's my recommendation. But as always, whatever you feel like doing, do it. But I don't know. So what do we have to be mindful of when it comes to consolidation? There are some basic issues that we have to be mindful of. The first thing here will be to determine our group structure. The group structure tells us about the ownership percentage of the parent, the subsidiary, and the associate, and also helps us to calculate the non-controlling interest, which is critical if there is no 100% ownership. So this is telling us the ownership issue. It's telling us about the non-controlling interest, but most importantly, it's also to inform us about the post-acquisition period. Because if the examiner asks us to prepare consolidated profit or loss, then and the post-acquisition period is less than 1 year, that means when it comes to the subsidiaries information, you are going to pick X over 12 of the subsidiaries revenue, cost of sales, and all of the other items. Let me take that again. If the post-acquisition period is less than a year, that means when it comes to the subsidiary, you're going to pick X over 12, meaning if the post-acquisition period is 8 months, then you're going to do 8 over 12 of the subsidiaries data for the most part to be able to prepare consolidated profit or loss. Number 2, it then means that part of the remaining period before the parent did the acquisition, the profit for that period will be added to the net asset at acquisition calculation. Let's take that again. When the ownership or the period of acquisition is less than 12 months, when we are preparing consolidated P&L account, the subsidiaries data we're going to take will be the post-acquisition period over 12 times the items in the P&L account. But you have to be careful that the remaining period, so if the post-acquisition period is 8 months, that means they have been in operation for how many months? 4 months before we acquired them. So that 4 over 12 of their profit for the year must be added when we are calculating the net asset at acquisition. That's the first principle you got to undertake. You got to know about. That's the first principle. So our group structure, that is what is telling us. What is the ownership? What is the NCI? What is the post-acquisition period? Then how are we going to be taking the flow in the financial statement? Now, for simple group structure financial reporting students, we don't have problem with ownership structure or the group structure, because if the parent acquires a subsidiary and they acquire 80% of the subsidiary, then the NCI will be 20%. No miracles, no challenges there. Then if there is an associate, yes, we bring in the associate, we acquire maybe 40% of the associate. The same thing happens with the post-acquisition period for the associate. But with complex group structure in the corporate reporting students, what may be happening is that probably the parent company has a subsidiary, and the subsidiary may also have an investment in another company. And so it means we have to then calculate the non-controlling interest in the second company, which is the subsidiary. And the way we calculate the non-controlling interest in the subsidiary by default is to bring in the direct investments that the parent has, if they have any, So direct investment in the sub-subsidiary will come. Then we'll bring in the indirect investment they have through the subsidiary. The indirect investment they have through the subsidiary, because the rule is that any investment the company in the middle makes, which is a subsidiary, both the parent and the non-controlling interest in the subsidiary have their share of ownership of that investment. That is another principle we need to understand, and this is exclusive for corporate reporting students. Any investment the subsidiary makes, both the parent and the non-controlling interest in the subsidiary will have their share of ownership of that investment. And so that is the indirect investment we are talking about. So that, let's say in the context of this question, the parent entity owns in the subsidiary, in the sub-subsidiary, some 20% share. So coming up here, the direct investment is going to be 20%. Okay, then let's say that the subsidiary goes to buy 60% in the sub-subsidiary. So the direct investment is 20%. That's the parent's own investment. And then the indirect investment will be parent's ownership, 80% of the 60%. And so that is going to give us 80, 60, 100, 48%. So in total, the parent now has ownership of 68%, so that the non-controlling interest in the sub-subsidiary will be the balancing figure 32%. This is calculating the NCI in the sub-subsidiary. Now, assuming the parent had no direct investment, then their investment in the sub-subsidiary would then have been just 48%. Now, although it is 48%, you don't say, oh, we can't consolidate their financial statement. We will still consolidate the financial statement of the sub-subsidiary. Why? The parent controls the subsidiary and the subsidiary controls the sub-subsidiary. Does that make sense? And the subsidiary controls the sub-subsidiary. So that is the idea about what is happening here. So since they own 60%, although the parent ownership is just 48%, we will still consolidate their financial statement. So that will be the first thing you need to always understand. Get your group structure. That tells us about the ownership flow of the parent. It tells us about the NCI, both in the subsidiary and the sub-subsidiary. Then most importantly, the post-acquisition period, because that is going to be affecting the way we calculate the post-acquisition period and also how we calculate the net assets at the date of acquisition. That's the first principle that we must understand. Once we get the group structure flow situation coming in, it then going to direct us automatically to one of the fundamental areas that the examiner will be asking you to do. Even if it doesn't ask you, you have to do it. Goodwill calculation. And goodwill, as always, it's going to be the fair value of consideration transferred. Fair value of consideration transferred. We bring in the fair value of non-controlling interest. That gives us the fair value of the business that we are acquiring. Then we less the net asset at acquisition. But the beauty of this is that if our goodwill, we finish and our goodwill is negative, if the goodwill is positive, that's okay. It means we will recognize the goodwill on the face of the statement of financial position if you are preparing consolidated statement of financial position. But if we get a negative goodwill, that will be referred to as gain on acquisition. Gain on acquisition, and that is an income. So when we are preparing consolidated profit or loss, that will come as a line item after the gross profit, gain on acquisition. But if you are preparing consolidated statement of financial position, this gain on acquisition will be brought as an addition in the consolidated retained earnings or group retained earnings. So when we calculate and the goodwill is negative, that is gain on acquisition. It means if you are doing consolidated statement of financial position, there will be no goodwill to be recognized on the face of the financial statement. But if the goodwill is positive, then that is okay. So if the goodwill is positive, then we may have an impairment testing situation coming in. So if there's an impairment in goodwill, that will be deducted, and boom, you get a goodwill at the reporting date, which will go on the face of the statement of financial position if we are preparing consolidated statement of financial position. Now, you got to be mindful because sometimes the examiner will say, calculate goodwill at acquisition. Or he will just say, he will be quiet, so prepare consolidated statement of financial position. Now, if the examiner says calculate goodwill at acquisition, you have to be mindful of calculating goodwill at acquisition. Don't go deeper and come and give us goodwill at the reporting date. That's not what you ask. If you decide to be Father Christmas in the exam hall, you're going to lose marks just trying to be Father Christmas. So that is the idea about goodwill. Remember, there is about 3 to 5 mark question depending on how the examiner is excited on goodwill calculation. But this is the deal. The goodwill calculation is not just going to be there for you to just pick it up and go away. So there are a couple of things you need to understand, and the first one here is the fair value of consideration transferred. It depends on the context of the question, but there are 4 things you must understand when it comes to the fair value of consideration transferred. 4. The first one is cash consideration. This is where we are told that, oh, the company is paying X amount of money, either per share, in which case you will multiply the per share by the number of shares acquired so that you get a cash consideration. Or the examiner will just say, oh, we acquired this for X amount of money, so the full cash consideration is given. That is not a miracle. It'll be direct, straight there, you pick it up and work with it. That is the idea about the issue in respect of cash consideration. So no miracles, it'll be stated directly. You wouldn't have to bother yourself for the most part. But the second thing could be what we refer to as contingent consideration. Contingent consideration. What the heck is that? Contingent means we're going to make some payment in the future, but it is dependent on meeting certain terms and conditions. That's what contingent consideration is. We're going to be making some payment in the future, but it is dependent on the subsidiary meeting certain conditions. And normally for contingent consideration, because it's a payment we're going to make in the future, we're going to apply IAS 37 rule, which means we have to discount it into present terms. Then the present value will be what you are going to be bringing here to get your fair value of consideration transferred. And then for the post-acquisition period, what do? Unwinding. That's the finance cost. And that will be calculated and recognized. If you are preparing consolidated P&L, then it will be added to the finance cost. If you are preparing consolidated statement of financial position, then the unwinding figure will be brought into group retained earnings as a deduction. So you apply the IAS 37 rule for contingent consideration. But for the most part, the examiner may tell you to ignore time value of money. If the examiner states directly that you should ignore time value of money, then whatever amount that they have decided to pay at the date of acquisition will be the amount you're going to use to determine the fair value of consideration transferred. But there is a catch there. If at the reporting date the subsidiary had not met the condition, and for that reason the contingent consideration is revised downward, the difference becomes a gain. So if, for instance, at the date of acquisition, the entity says they're going to pay $10,000, and the examiner says ignore time value of money. So that is the $10,000 you're going to bring here. But if at the reporting date, the question says, oh, the subsidiary is not able to meet the condition, so instead of $10,000, the parent is now going to pay $8,700. All right, what does that mean? It means there is a reduction in liability. Reduction in liability is what? A gain. So there is now a gain of 1,300. So if we are preparing consolidated profit or loss, then this 1,300 will come as a line item. That is reduction in contingent consideration as an addition. But if you are preparing the consolidated statement of financial position, this 1,003 reduction in gain will come to consolidated retained earnings or group retained earnings as an addition. Then when we go to the consolidated statement of financial position, the revised figure of 8,700 is what will be recognized as a liability. Now, if it is going to be paid in the next 12 months, then it will be under current liabilities. But if it is going to be paid in more than 12 months, then it will go under non-current liabilities. So that is the idea about contingent consideration and how it has to be treated. Just close to contingent consideration is his brother, that is deferred consideration. With deferred consideration here, again, it's a future payment we're going to make to the shareholders of the subsidiary, but we're not going to attach any condition. So it's a standardized payment we're going to make in the future. Again, we apply IAS 37 here, so we'll calculate the present value of that. For deferred consideration, always we will take into consideration time value of money, so we'll discount it to present value using the parent's cost of capital. Using the parent's cost of capital, because who is going to make the payment? The parent entity. So we use the parent's cost of capital to determine the present value. That present value is what we bring in arriving at our fair value of consideration transferred. Then for the post-acquisition period, unwinding or finance cost. So you calculate the finance cost, and if you are preparing consolidated P&L, it will be added to the finance cost. If you are preparing consolidated statement of financial position, we come to group retained earnings, it will be subtracted there. Then on the face of the statement of financial position, the unwinding will be added to the present value, and that becomes the carrying amount of the deferred consideration on the face of the statement of financial position. If the payment is due to be made in less than 12 months, current liabilities. If the payment is due to be made in more than 12 months, non-current liabilities. So that is also the way we deal with contingent consideration. Number 4, it's going to be share exchange. As the name suggests, this is where the parent entity is issuing shares to the shareholders of the subsidiary as part of the financing the acquisition. Okay, the parent entity is issuing shares to the subsidiaries shareholders as part of financing the acquisition. So be careful here. Who is issuing the shares? The parent entity is issuing the shares. So you're going to do the calculation. How many shares have we acquired and what is the exchange policy? They could say 2 for 3. Okay, that will be 2/3 multiplied by the number of shares we have acquired. Now, because it is the parent issuing the shares, we have to value the shares at the parent's share price. Okay, we value the shares at the parent's share price, and that is how we get the share exchange figure. But if the entity has not recorded this transaction yet, then if we are preparing consolidated statement of financial position, this must be brought in and added to the share capital of the parent entity, and will recognize share premium as well, because this must be splitted between share capital and share premium, and you know how to do that already. I'm not the one to tell you that this time. So that is share exchange. Then the final part is sometimes they can finance the acquisition using loan notes. So issue of loan notes. The reason is that sometimes when you do share exchange, it results into dilution in the ownership of the parent company. And so the shareholders of the parent entity may say, no, don't do share exchange, because more shares will be issued and you will dilute our ownership, you will dilute control, you will dilute earnings per share. Instead, do issue of loan notes. So if the parent is issuing loan notes, yes, what is the issue policy? That will be stated in the question. You have to read that to get a value of the loan notes. And as always, when loan notes are issued, interest will be paid during the post-acquisition period. So sometimes the examiner may say, oh, they have already accounted for it. If the question is quiet, you can also ignore it and assume that the interest on the loan note has already been accounted for. But if you don't keep it quiet, or you are not quiet about it, and you decide to calculate the interest for the post-acquisition period, that's fine. You just add that to finance cost if you are preparing consolidated statement of profit or loss. But if you are preparing consolidated statement of financial position, then that will be subtracted from group retained earnings. And when we go on the consolidated statement of financial position, this loan note figure will come there under non-current liabilities, including that accrued interest which you have calculated for the post-acquisition period. So these are the issues that we must understand. Depending on how excited the examiner is, sometimes you can just have the cash consideration coming in, boom, you are gone. Other times the examiner will just do share exchange, boom, you are gone. But it depends on how excited the examiner is. He could bring a mixture of these, and you have to understand how each of these must be treated. So that is the first thing, how we deal with the key elements of the fair value of consideration transferred. And in the question, the examiner will tell you all of the data you need about the fair value of consideration transferred. You must understand how to fish these things out in the financial statement. So that's the first item that we see there. So like I said, it may not be given straight up. You got to figure it out yourself. Then the final thing is going to be the issue about non-controlling interest, right? It depends again on the context of the question, but there are two ways that non-controlling interest can be valued. Either they are valued at fair value, or they are valued at a proportionate share of the net asset of the subsidiary. The reason why this is important is because of impairment in goodwill. If NCI is valued at fair value, then any impairment in goodwill must be shared between the non-controlling interest and the parent entity. But if the NCI is valued at a proportionate share of the net asset of the subsidiary, then impairment in goodwill will not be shared. It will solely be borne by the by the parent entity. So that is why we have to know. Now, if in the question, the examiner never tells you anything about non-controlling interest, which is possible, there are a couple of questions like that. You will read the whole note and nothing is mentioned about the NCI. If the question is quiet like that, you have no option, but you have to use the proportionate method to value the NCI. The proportionate method simply means you pick the NCI's ownership, okay, NCI's ownership of the subsidiary, multiply by the net asset of the subsidiary. Okay, multiply by the net asset of the sub. That's all. Now remember, I didn't say net asset of the sub at acquisition. Neither did I say net asset of the sub at reporting. I just said net asset of the sub. Period. So it means if we are calculating goodwill, and we want to get the NCI value, then goodwill is at acquisition. So we need to get a net asset at acquisition. Then we take the NCI share of that and build that into the system to be able to get the value of the company. So that is also about the NCI. It could be valued at fair value or valued at a proportionate method. The context of the question will tell you. But like I said, if you read all the notes and nothing is mentioned about NCI, then you got to use the proportionate method to be able to get your value for the NCI. But the key thing is this: if NCI is valued at fair value, impairment in goodwill will be shared. But if NCI is valued at the proportionate of the net asset of the subsidiary, then there will be no sharing of the impairment in goodwill. That is the idea about the second issue, NCI. Then the final issue is going to be the net asset at acquisition flow, so that we can get our issue here. Now, we said that we have our OGs who would do net asset at acquisition, net asset at a reporting date, whatever the heck you want to do. I mean, it's your flow, but that's the idea. But a couple of things that you just want to pay attention to, for the most part, it's going to be that, all right, if you want to go OG, then net asset at reporting, net asset at acquisition, we're going to have the share capital coming in as always, and it's going to be the same because they're not going to issue any shares. If they have share premium, why not? It's going to be there at acquisition at reporting date. Remember, the net asset schedule is information about your subsidiary or your subsidiary for the corporate reporting students. So it's about the subsidiary and the subsidiary. That is very important for you to understand. Then we bring in the retained earnings. Yes, at the reporting will be here. At acquisition, now you got to be careful because at acquisition may not be given. If it is not given, you got to figure it out yourself. And that was something that I said earlier when we were talking about the group structure a moment ago. That if, for instance, the post-acquisition period is not a year, then a portion of the profits that they have earned for the current year will have to be brought into the net asset at acquisition. So this is the trick. Let's say we're giving the retained earnings at the date of acquisition. Then that figure will come at the reporting date and at the end of the year. Then the profit for the year from their P&L accounts, the full profit for the year will come to the reporting date. Okay? But if it is not a full year acquisition, then the pre-acquisition profit for that year is what will come at the date of acquisition. That was the thing that I was talking to you about here under the group structure. So let me take that again. If it happens that a post-acquisition period is less than a year, and let's assume that we are giving the retained earnings at the date of acquisition, then that retained earnings at the date of acquisition figure will come at acquisition, will come at reporting. Then their profit for the year, the whole figure will be brought at reporting. But since the acquisition or the post-acquisition period is less than a year, the pre-acquisition profit of that year's profit will come at the date of acquisition. So if it is 8 months post-acquisition period, then 4/12 times the profit for the year will be a pre-acquisition profit that will come at the date of acquisition. So that is the context there and what you need to understand when it comes to dealing with that. Then right after this, you're gonna have your fair value adjustment situations. There is nothing I'm gonna say here because it'll be based on the accounting standards, and I believe that you know the accounting standards when it comes to dealing with fair value adjustment. The fair value adjustment arises because the assets and the liabilities of the subsidiaries will be revalued at the date of acquisition. And so when this revaluation occurs, two things can happen. Either, or a couple of things can happen. One, either the subsidiary is carrying some assets above the amounts, the fair value, or below the fair value. Read the grammar well. The text will be clearly there. Make sure you read it and interpret your thing. It is either going to be above or below, but you have to be careful about the arrangement of the words. They could say, oh, having a carrying amount of 4,000 above the fair value, or having a fair value of 3,000 above the carrying amount. These two statements are different. You gotta make sure you read the blueprint and understand what the heck is going on in the context of the question. That's very important. So that's the first thing that could happen. Either they are overstating their assets or understating their assets, in which case post-acquisition depreciation would have to be charged. And you have to know how to adjust for all that also on the face of the consolidated statement of financial position for the PPE situations. Another thing that could happen on the fair value situation also is that the entity or the subsidiary may be recognizing certain items that are not supposed to be recognized from a consolidation perspective, or that are supposed to be recognized from a consolidation perspective. And so that is why I said here, all you must know about is the accounting standards. And the examiner has no limit. He has no boundaries here. He is not confined here. So IAS 16, IAS 23, IAS 37, you can have contingent liabilities issues coming up here. Hey, it could even be IAS 2, inventories. The examiner has no boundaries. It depends on the context of the question. So to succeed in understanding deeply the structure of the effect of the fair value adjustment, you gotta be strong about the accounting standards in the context of the question given and how the treatment must be done. And this is one of the areas that students screw up. And since it's one of the areas students screw up, it means goodwill calculation is going to be one of the areas that students will get wrong. And again, that is why I said do not start with consolidation, because it's going to require you to do a lot of things. But that is the idea about our goodwill calculation. So the fair value of consideration transferred, the elements and what we do with them, calculation of the NCI, the two methods and the implication of them, and then number 3, your net asset schedule, the various things that you have to pay attention to. So that is our second broad issue: group structure, goodwill calculation. But the goodwill calculation has a number of things that are embedded in it. Okay. Then the third thing, which is going to be my final thing here on consolidation, it's going to be the concept of intragroup trading. It's going to be the concept of intragroup trading. For the most part, financial reporting, whether I like it or not, this is waiting for you. There's gonna be some intragroup trading. For corporate reporting people, you are big girls and boys, so you may go to the exam and there is no intragroup trading. Yeah, because there are other serious issues that the examiner would want to flex you on. But for financial reporting students, it's a regular topic or it's a regular note. You're going to see intragroup trading there, so you better understand the principles. Corporate reporting students, it's not every day that the examiner will get excited on intragroup trading. Nonetheless, you got to make sure you understand the principles because it's very important. Intragroup trading means that they are trading among themselves. And so it depends on the statement we are preparing and how the treatment has to be done. So let's see it. Number one, sale of goods. So if they are selling goods, that is the parent and the subsidiary, or the subsidiary and the sub-subsidiary, they are trading among themselves. So parent and sub, or subsidiary and sub-subsidiary. As far as there is trading in terms of goods, the first question we need to ask ourselves is, what financial statement are we preparing? Number one, if we are preparing the consolidated profit or loss, then quickly, the rule is we need to cancel all in post-acquisition intragroup sales. So we eliminate all post-acquisition intragroup sales. Keyword, post-acquisition. Because there is a trap there that sometimes they may be trading between them before the acquisition. And the acquisition period may not be a full year. It may be part way in the year. And so the word or the key thing there is the post-acquisition intragroup sales. So if they were trading among or between themselves before the parent entity took control over the subsidiary, we are not going to cancel the total sales for the year. We are only going to be canceling the sales for the post-acquisition period. And how do you cancel that? Debit revenue. Revenue has a credit balance. So when we say debit revenue, we mean subtract it. Then you credit the cost of sales. When we say credit cost of sales is an expenses, has a debit balance. So when we say credit cost of sales, it means subtract it. So if we are preparing consolidated profit or loss, then, and there is sale of goods between parent and sub, or between sub and sub-subsidiary, the total post-acquisition sales must be eliminated. That's the first thing we do. Then, if there is any goods not sold yet by the other party who bought the goods, or there are some goods in transit, then we have to calculate post-acquisition period. Did I say post-acquisition period? We have to calculate provision for unrealized profit. So we calculate provision for unrealized profit on unsold inventory in stock and goods in transit, if they have any goods in transit. And the rule for the calculation, it's going to be given. They will say, okay, the company sells at cost plus, and you have the selling price. So you do the markup 100 plus the markup times the selling price, and you get your PUP. Or you can go with a KG2 approach. Sales equals selling price. Sorry, sales equals cost price plus profit. Then you get your answers coming up there. But you got to calculate the provision for unrealized profit. But what is the double entry for that? Okay. It depends on who is selling and which financial statement we are preparing. But this is the generic rule for the provision for unrealized profit. Number one, we're going to debit cost of sales. We debit cost of sales. Now, again, cost of sales is an expenses. So when we say debit cost of sales, what are we saying? We are saying add it to the cost of sales. So you debit the cost of sales if you are preparing consolidated profit or loss. So if you are preparing consolidated profit or loss, the provision for unrealized profit that you calculated on the unsold inventories in stock of the other party who bought it and any goods in transit, you add it to cost of sales. Then, if the subsidiary is the one selling, you have to debit the subsidiary's profit for the year. So this is if the subsidiary is the one selling. If the subsidiary is the one selling, you have to debit the profit for the year of the subsidiary. Which means if you are doing your net asset schedule, at the reporting date, provision for unrealized profit, if the subsidiary is the one selling, will be deducted at the reporting date on your net asset schedule. If the parent is the one selling, then the provision for unrealized profit will be deducted from the group retained earnings. That is if the parent is the one selling. So get a context very well in respect of how the treatment is done. It depends on the financial statement you are preparing, number one, and who is doing the sales. Who is doing the sales? Then the corresponding entry is you're going to credit inventory. You don't need a miracle on that. So you credit inventory, which means you subtract it from the inventory figure on the face of the consolidated statement of financial position. Now, if you are preparing just consolidated P&L, then you wouldn't need group retained earnings. You wouldn't need the inventory as well if you are doing consolidated P&L. There's no P on that. So that is what we do to the post-acquisition sales and provision for unrealized profit on the unsold inventory for the entity. Then the last thing about the goods that we are selling will be reconciliation of the current accounts. Reconciliation of the current accounts. Now, at the end of the year, nobody is supposed to owe someone because the two shall be one. Consolidated financial statement is preparing the financial statement of the group as though they are a single economic entity. That's it. So if the two shall be one or the three shall be one, then no one is supposed to owe someone. So if at the reporting date there is any balance existing between them, we have to cancel it. And you know how the reconciliation is done. Whoever is selling will have the balancing figure in their receivables. Whoever is buying will have the balancing figure in their payables for the most part in that particular case, and then that would then help you to do the reconciliation. But remember, there could be two reasons why the accounts will not balance: goods in transit or cash in transit. All we do is with cash in transit, you push it into the account of the one who is supposed to receive it, so that now on your consolidated statement of financial position, you bring the parent's cash, the subsidiary's cash, then you bring in the cash in transit. Then it could also be goods in transit, which means the one selling has sent the goods to the ones buying, but they hadn't received it yet until after the reporting date. And so in that case, when we go to the consolidated statement of financial position, we're going to bring inventory, the parent inventory, the subsidiary's inventory, then we bring in the goods in transit, then we subtract provision for unrealized profit on the goods in transit, because I just told you here that when we are calculating provision for unrealized profit, it is on both the unsold inventories as well as the goods in transit. And these are the things that we must understand when we talk about sale of goods and the various adjustments that must be made. Remember, the reconciliation will only be done if you are preparing consolidated statement of financial position. If you are preparing statement of P&L, we don't need any reconciliation. All we need is the elimination of the post-acquisition sales and the adjustment for the provision for unrealized profit. We wouldn't need the reconciliation. But if you are doing statement of financial position and the balances are not balancing between them, then we would have to prepare the reconciliation account, and that will be like two reasons I've said: either there is cash in transit or goods in transit, and that will be adjusted for the reconciliation account. That is the first thing, sale of goods. Final thing that I would want to share my thought on, and then it will be done here, will be sale of non-current assets. So sometimes in trading among themselves, there could be transfer of assets among them. So the parent could transfer an asset to the subsidiary could transfer an asset to the parent. Like we have said, nobody is supposed to sell anything among anybody, so we're going to cancel the sale that occurred. And so one thing is going to happen. Number one, in the books of the books of the seller, we would have to eliminate any unrealized profit or loss that they have recognized. Are you getting it? Any unrealized profit or loss that they have recognized, we will have to eliminate that. So any unrealized profit or loss, did I say profit or loss? Maybe let me say gain or loss, must be eliminated. So again, you know this already, and we've discussed this already, so there's no need for me to go through it. But let's say that the carrying value of the asset is say 10,000, and it was sold for say 8,200. That means the seller sold this and made a loss on the disposal of 1,800. That loss, they treated this as an expenses in their books. So we're going to reverse that. If we are going to reverse that, what happens? So it means that we are going to be saying that we will debit PPE with that 1,800. So consolidated PPE. Okay, the consolidated PPE will be debited with that loss, and then we'll credit. Let's say the parent is the one selling, we'll credit the group retained earnings, or if the subsidiary is the one selling, we'll credit their profit or loss. Because the loss was treated as an expenses in their books. So we are reversing that expenses. And so now we have to recognize an income to cancel that expenses they had recognized. That is the idea about what we do in the seller's books. Then in the books of whoever bought it, the buyer, they are going to be carrying the asset at the fair value. So either they will charge more depreciation if the parent, if the seller sold it at a gain, or they will charge less depreciation if the seller sold it at a loss. So what is going to be happening is that we have to calculate the consolidated depreciation figure and look at whether they have charged more or less, and reverse that again in the PPA accounts and also in their profit for the year or group retained earnings. So that is how we deal also with the issue about the sale of non-current asset. So in the books of the seller, we reverse the gain or loss they had recognized. In the books of the buyer, depending on the structure of whether they bought it at a higher amount over the carrying amount or a lesser amount over the carrying amount, for consolidation purposes, the two shall be one. So either they will charge more, they had charged more depreciation or less depreciation. That excess depreciation would have to be reversed both in the PPE as well as in their profit for the year. That is how we deal with the sale of non-current assets as well. And these are a number of issues that you must understand when it comes to dealing with consolidated financial statements. So your group structure, getting your ownership, NCI, post-acquisition period, goodwill calculation, knowing the various elements, fair value of consideration transferred, NCI valuation, intragroup trading, knowing the way the various adjustment has to be made, depending on the context of the question and what we are preparing. These are the things that you must understand when we talk about consolidated financial statement. Again, there's a lot of things going on depending on the context of the question, and so that is why I said you make sure that this is going to be your last but one question, and the goal is for you to come take some easy marks in respect of goodwill calculation, group structure situation, dealing with some intra-group issues, and not being in a hurry to go and try to extract the financial statement, because you're not going to get anything for that if the ultimate figure is not at the cash column of the financial statement that you are extracting. So these are the things that we must understand when it comes to dealing with consolidated financial statement. If there are any specific questions, again, for those of you with me on Zoom, you can raise your hand, I'll bring you up, or you put it in the chat for me. Then those of you also on YouTube, you can put it in the chat for me if there is any specific question on the consolidation or the issues that I've spoken about. Remember, corporate reporting students, I've told you in the notes to the consolidated financial statements, we may have IFRS 2 share based payment situations, and then IAS 19 employee benefit stories coming up. Whatever be the case, the treatment will be the same as you know already from the IAS 19 situation and from IFRS 2 situation. It doesn't change the way the treatment will be done for consolidation purposes. All right, so let's see. I think got some things here on what YouTube. Okay, I think there is no question in my YouTube, just some comments. I think I'll come back to that later on. Let's see. Prince Boydie, under sale and leaseback, where the sales value is below the fair value, is the prepayment added to the present value of where the sales value is below the fair value, is the prepayment added to the present value of the minimum lease payment before working out the amortization schedule? Which prepayment? You don't do that. I don't know the context of your question, but we calculate lease liability and work. If it is prepayment, why will you add it to the present value of minimum lease payments? I'll be talking about leases later on in the discussion, so if you're still on the call, you can stay as when I get there. Maybe you can get some clarity on that. Okay, let's see. Bring back my slide here. Yes, Osma, your hand is up.
Yes. Sorry. Good evening, Nhyira. I have a question. There's this question I came across, and the cost is plus 5/8, 5/8. That is 5/8 of, I think, sales at cost plus 5/8. Right? It's getting me.
I don't understand what you're saying now. I don't know. I think maybe your network or something like that. You can put it in the chat, and then we can look at, because we don't have time to have any lag in network. So you can put it in the chat or check your network and come back, because I can't follow what you are saying. Yes, Benjamin, your hand is up.
Okay, Nhyira, what the lady is talking about is about intergroup sales that she's talking about. And like at the end, the question is providing like the goods that is left unsold. Maybe on the subsidiary side is 26,000. Let me say 26. And they said it's 5 over 6. So she was talking about 5/8. So it means that you are going to add the 5% plus the 8. That's what he's talking about. It's just like the margin and markup issue.
I don't think I understand what you just said as well. I think she has put a chart for me. It's about intergroup sales at cost plus 5 over 8. Yeah, if cost plus 5 over 8, it's cost plus 5 over 8 is the same as cost plus 20% or cost plus 50%. So that is the markup. So the markup is 5 over 8. So if the markup is 5 over 8, so you are saying cost plus 5 over 8. So 5 over 8 is the markup rate. You can decide to change that into percentages and work yourself out. So 5 over 8 times 100, that's like 62.5%. So it means it is cost plus 62.5. So depending on what you have in the question, if it is the invoice value you have or the sales value you have, then your PUP will be 62.5% over 100 plus 62.5% times the sales value or invoice you have. That's not an issue. That's the treatment there. So cost plus 5 over 8 is just like cost plus 62.5%. So you can just, like I said, convert the fraction into percentages and then work with it, and you get your answer coming in that regard. So that is the issue about that, Osmao. Let me know if that makes sense for you in relation to that. It's nothing difficult. You just convert the fraction into percentages and then you apply your normal rules and then you should be good. Okay. So that is the treatment for that. Any other question on this one? I'm seeing another question coming up here on the Zoom. Sorry, on YouTube. Let's see if I can take it because it relates to consolidation. Who is this? Nhyira 99 whatever. Say, how do we deal with revaluation gain when consolidating? Where are you getting revaluation gain? What's the context of the notes? Like, I don't understand what's going on. You have to know the context of the notes, because if you are thinking about revaluation gain like when you are doing fair value adjustment and that, oh, the subsidiaries, the asset has had a carrying amount of say 5,000, but the fair value at the date of acquisition is say 7,000. So you are thinking that there is a gain of 2,000. We don't deal with anything like that. So I don't know the context of your revaluation gain here, because if it is fair value adjustment, we don't bring any revaluation gain situation. We just deal with the fair value adjustment, calculate any additional post-acquisition depreciation, adjust for that on the face of the statement of financial position for the NPP schedule. There is no revaluation gain there. So I don't know where your revaluation gain context is coming from. So maybe you can give me some data, because like I said, if it is fair value adjustment situation, there is nothing like revaluation in consolidation. The only time that there will be revaluation in consolidation is when maybe in the post-acquisition period, the parents revalue their assets, or they revalue the gain, the assets of the subsidiary, in which case revaluation gain will be treated the same way you know how revaluation gain is supposed to be treated in accordance with IAS 16 property, plant and equipment. So that's why I said context. Like, where is that idea coming from? Probably give me some context where you are asking that from, then I can say something better. If not, there wouldn't be any revaluation gain situation really. So give me some context there, then I can provide you with some answers. Okay, so I think these are the questions I have on consolidation situation. Okay. Number 2, as we go to question 2, this is going to be on the accounting standards. Question 2 will be on accounting standards, whether we are in financial reporting or in corporate reporting. Question 2 will be on standards. I've told you this already. We're going to have questions coming in from the non-current asset standards. So the IAS 16, IAS 20, IAS 23, IAS 40, IAS 37, IAS 38, IAS 36, IFRS 5, all these are non-current asset standards. Whether you like it or not, 2 of these will be waiting for you in the exam hall. 2 of these will be waiting for you in the exam. Why did I? Whether I like it or not, 2 of these at least will be waiting for you in the exam hall. So there will be questions dedicated on non-current asset standards. Got to be mindful of that. Now, for corporate reporting students, in addition to this non-current asset standards, we have accounting standards specifically, like the IAS 19, IFRS 2, and then IFRS 8 operating segments. That's really there. But IFRS 2 share-based payment, IAS 19. We could have dedicated questions on this. Or like I said, it will be part of the consolidation situation. So it depends on the context of the question. Okay? It depends on the context of the question. But we're going to have questions on non-current asset standards. And I think I've told you this over and over again during our discussion sessions. So you got to be mindful of that and be prepared for that. So all these standards, you have to know about them, because 2 of them at least will be there in the exam hall for you in the question 2 dedicated. Then these 3 standards work hand in hand. Depending on how excited the examiner is, at least one of them will be in the exam hall. Okay? Depending on how excited the examiner is, at least one of them will be in the exam hall. If the examiner gets a lot of goosebumps, then he's going to bring 2 of them, both in corporate reporting and financial reporting. So the principles here must be understood very well for us to increase our chances of passing the examination. We've discussed this in IFRS 15, revenue from contract with customers. We go with a 5-step framework for recognition of revenue, and we said we only recognize revenue when a performance obligation is satisfied. However, if we receive payment prior to the satisfaction of any performance obligation, that payment will be recognized as what? A deferred income. Okay, we cannot recognize it as revenue. It will be recognized as a deferred income. So the 5-step framework, very important. It's a theory the examiner can also ask you. And then the fact that we recognize revenue when a performance obligation is satisfied, and then the fact that when the entity receives payment in advance or prior to the satisfaction of a performance obligation, then that will be recognized as a deferred income. Next principle is, if there is a situation where the entity sells also makes sales on credit, and there is some credit terms given to the customer, then quickly we have to understand that the sales value has 2 components: the revenue component and the finance income component. Let me take that again. Again, all these depends on the context of the question. But if the entity makes sales and the customer is giving some credit terms, and we are giving the cost of capital of the entity making the sales, then we have to understand that the fair value of the sales has 2 components: the revenue component and the finance income. How do we get the revenue component? By discounting the fair value of the sales into present value using the cost of capital of the entity over the period of the credit term. So that present value figure becomes the revenue. Then the balancing figure, which is the fair value of the sales and the present value, becomes the finance income. And that will be recognized on a time apportion basis over the period until the payment is made by the customer. So these are some of the things you need to understand on the default way when we are dealing with IFRS 15, revenue from contract with customers. But when a performance obligation goes beyond one accounting year, what did we say? We said that in that case, we would have to first calculate the profit or loss on the project, right? On the contract. And if it results into a loss, in accordance with IAS 37, that will be treated as an onerous contract. So that loss must be provided for because it's an onerous contract. And in that case, the revenue we recognize and the cost will be equivalent to the cost that has been incurred to that reporting date. But if the contract results into a profit, then the allocation of revenue and profit will be based on the percentage of completion. And if you remember, we said with the percentage of completion, it depends on the context of the question. We can use the input method or the output method, and the percentage of completion would then guide us to be able to know how much revenue to be recognized and how much profits to be recognized, and the balancing figure of which will be going into cost of sales for the entity. So these are the ideas about what we need to understand. And certainly on the face of the statement of financial position, see what ECG is doing now. Just playing with the lights. It's gone. Please give me a sec. Let me try to put up an alternative light here. Okay, so let's go. Um, let's continue quickly. Let me see if my stream is up on YouTube as well. I mean, this whole country is like crime scene. Give me a sec. Let's see. That's okay. So let's go. think my YouTube stream should also be. Sorry. I'll make sure my YouTube stream is up as well as we go. Is my stream still up? Yep. Yeah, so let's go. All right, let's go. Okay, so that is the idea about how we recognize revenue when performance obligation is beyond 1 year and we are dealing with construction contract environment in that particular case. So that's generally the idea about IFRS 15 revenue from contracts with customers. Then the second standard there will be the issue about leases for the most part. And in leases and IFRS 16, what we are saying here is that we need to know about the lessor accounting because under IFRS 16, it is the lessor that will be classifying the lease as a finance lease or an operating lease, right? It is the lessor that will classify the lease as a finance lease or as an operating lease. So two things, either finance or capital lease or an operating lease. And we say there are rules that governs the classification. For instance, if the lease term is covering a greater percentage of the economic useful life of the asset, that is a capital lease. If the lessee has a right to buy the assets at the end of the lease term, that is a capital lease. If there will be transfer of ownership at the end of the lease term, that is a capital lease as well when it comes to dealing with leases. So we spoke about those conditions there. Now, if none of those conditions exist, then the lease will be treated as an operating lease. Now, if the lease is an operating lease, then the lessor will account for the asset in accordance with IAS 40 because it's an investment property and the asset will be carried at fair value, so that any fair value gain or loss will be recognized in the P&L account. Then the annual lease receivable from the lessee will be recognized as an income in the financial statement of the lessor. But if the criteria is met, okay, one of them, there has to be one of the terminologies that we discussed in the transaction or in the contract. If it is a finance lease, then we're going to be applying IFRS 16 lessor accounting, which will follow the same rule that, the lessee accounting will be amortized cost schedule, only that we're going to flip it up here. So here we're going to be looking at lease receivable, and the asset will be derecognized from the books of the lessor, and they have to recognize lease receivable and lease income that they will be receiving every year. So that is the idea about the lessor accounting and how we go about that generally. Then on the flip side, we're going to have the lessee accounting. And if you remember, what we said here is that the lessee would have to establish that there is a lease agreement here. And we said there is a lease agreement when the lessee has a significant control over the usage of the assets and substantial economic use, significant economic benefit in the asset will flow to the lessee. If that is the case, then there is a lease contract. If not, then it's a normal rentals, which means the lessee cannot recognize the assets in their books. They will just treat it as a normal rental. So the annual lease payment, quote unquote, will just be recognized as an operating expenses or as part of the operating expenses of the entity. And that is the idea about the criteria that must be met before the lessee says, hey, there is a lease. Okay, so if there is a lease, then the lessee has two ways that they can choose to account for the lease. The default method if you know, is where we said, hey, the lessee will recognize right of use, so we will debit ROU and recognize lease liability, or if you want, lease obligation. And we discussed the way all these things are calculated, but there is an alternative method that the lessee can choose, where the lessee will choose what we call the low value asset method. So this is where the lessee says that, yes, although I control this asset, I determine how this asset will be used, the significant economic benefit and service potential in this asset is flowing to me. I am seeing that asset as a low value asset. So in that case, if it is a low value asset, then the lessee will just account for it as normal rentals, meaning they will not recognize the lease in the books of the entity. Instead, what are they going to do? They will just do normal rentals. And so at the end of the year, they will just debit profit or loss with the annual lease payment and then credit cash. If it is outstanding, then they're going to credit current liabilities at the end of the period in that particular case. So from the perspective of the lessee, he has two options. Now, the context of the question will tell you. If the question is quiet, then certainly you go with a default approach, right? But sometimes the question can say, hey, the entity elect to apply the low value method for the recognition of the lease. If they elect to apply the low value method, then we go with the application of the low value method. And although, yes, we have recognized that there is a lease, we will treat it as normal rentals so that the annual lease payment will be recognized in the P&L account and nothing in the statement of financial position in respect of the asset or the liability on the lease payment. Now, if we go with a default method, the lease obligation, you remember we said it depends on whether the lease is paid in advance or the lease is paid in arrears. That means, is the lease paid at the beginning of the year or lease is paid at the end of the year? If lease is paid at the beginning of the year, your amortized cost schedule that you are going to be doing will be for only one period. Then the carrying amount will be splitted between current liabilities and non-current liabilities. The amount that will be recognized as a current liability will be the amounts that will be paid just the following day after the end of the year. Then the balancing figure will be non-current liabilities. But if the lease payment is made at the end of the year, then we'll do the schedule for 2 years. Both the current year ended and then the next year ended, so that the next year ended brought down becomes the non-current liabilities, and then the difference between the current year ended and the next year ended brought down becomes the current liability. So the second year ended be non-current, and then the difference between the two becomes the current liability. So that is the idea about the amortized cost schedule preparation. We've done that, and so you have to understand the principles. The key thing here is, if payment is made in advance at the beginning of the year, you do the schedule for only the current year. But if the payment is done at the end in arrears or at the end of the year, then we do the schedule for 2 years, both the current year and then the next year, so that we can split and get our current and non-current liabilities. Then the final thing is going to be the idea about the sale and leaseback. If we want to, the sale and leaseback. In the concept of the sale and leaseback, it's what has been said. The entity has sold the asset and they are leasing back the asset. Now, the way we recognize this is to ask ourselves, has performance obligation been satisfied? Have we satisfied performance obligation? That's the question. Two answers can come up. Yes, performance obligation has been satisfied. No, performance obligation has not been satisfied. If performance obligation is not satisfied, which is no, it means the sale is not a sale, but but it is a financial arrangement and the asset is used as a collateral facility. For that reason, all we would do is to apply IFRS 9 financial instrument so that the supposed seller will recognize financial liability, and then the supposed buyer will recognize financial asset, so that interest will be calculated on them, and then we get our figure coming in for the reporting date at the end of the period in that regard. So if performance obligation is not satisfied, then the sale is not a sale, but a financial arrangement, in which case we apply IFRS 9. Now, I'm giving you the generic principle because we don't know the books in which or whose books the entity, the examiner will ask us to prepare. If you are preparing in the books of the supposed seller, the original owner of the assets, and the performance obligation is not satisfied, then it is a financial arrangement, so we recognize financial liability. Then we'll calculate the interest expenses and recognize it in the P&L account. Right? And then we add that to the amount we got to get a closing carrying amount on the face of the statement of financial position. Then in the books of the supposed buyer, they've not bought the asset, so they can't recognize any asset, but they will recognize financial asset being the amount they gave to the seller for the transaction. And since they are recognizing financial assets, they will also calculate interest receivable on it, and that will be recognized as an income in their P&L account and also added to the financial asset on the face of the statement of financial position. So if performance obligation is not satisfied, then it's a financial arrangement. We apply IFRS 15. But if performance obligation is satisfied, then the sale is a sale. Right? So it is a sale. So it means they have sold the asset. So in the books of the supposed seller, the original owner, they have to de-recognize the asset because they've sold it. Then they have to recognize right of use. But the right of use they recognize will be dependent on the percentage of the carrying amount of the asset that they have retained. The percentage of the carrying amount of the assets that they have retained. Now, how do you get the percentage of the carrying amount of the asset that they have retained? Normally, that is going to be the present value of the lease payment, of the minimum lease payment, divided by, if you want the fair value of the asset, multiplied by 100. That is to get us the percentage of the asset that has been retained. Percentage of the asset retained. And once we get a percentage of the assets retained, we can now calculate the percentage of the asset that has been transferred and then calculate the gain or loss on that for the most part. So when performance obligation is satisfied, the seller would de-recognize the asset at the carrying amount at the date of the disposal. Then they have to recognize the proceeds from the sale. So journal entry will look like this if performance obligation is satisfied. We could have debit, credit. We'll have the cash coming up, which will be debited for the most part. Then the right of use, which is the percentage of the carrying amount that they have retained, that will come up, which is going to be based on your calculation. So this calculation, percentage of assets retained, when you get a percentage, your ROU will become that percentage times the carrying amount of the asset. That is what is going to be coming here. Then we recognize lease liability, which is going to be the present value of the minimum lease payment, which you will calculate or the examiner will give to you, and that's going to be credited in that particular case. Then, like I said, we de-recognize the asset, which means you credit it with the carrying amount or the carrying value of the asset to de-recognize. And so at the end of the day, when you balance this figure, the balancing figure will either be on the credit side, which is a gain, or the debit side, which is a loss on the amount that has been transferred or the amount that has been disposed. So we could either have gain or loss. If it's on the credit side, it's a gain. If it's on the debit side, it is a loss. So in a sale and leaseback, where performance obligation is satisfied in the books of the seller, this is what we do. We derecognize the asset, so like I said, credit it, but then we have to recognize lease obligation, normal one. Then we have to recognize the right of use. How do you recognize the right of use? It is going to be based on the percentage of the carrying amounts that you have retained. And so that is going to be the present value of the minimum lease payment divided by the fair value of the asset. If we are told in the question that the present value of the minimum lease payment is equal to the fair value of the asset, that means we have retained 100% of the asset for the most part. We have retained 100% of the asset for the most part. And that is what you must understand under the sale or lease back. And some of you asked a question about this, I think on YouTube as well as on the Zoom call, about the treatment of the sale and lease back. And that is what you must understand about that. But two things may happen. Sometimes the fair value of the asset could be greater than the proceeds we got, or the fair value of the asset will be less than the proceeds we got. So let me explain. If the fair value of the asset is say 10,000, but the actual proceeds we got is 8,000, that means the buyer, in this case, who becomes the lessor, he was supposed to have given us 10,000, but he gave us only 8,000. Why? The difference 2,000 is going to be dealt with as lease prepayment. And that will be recognized as a line item on the face of the financial position and will be allocated every year over the lease term. Will be allocated every year over the lease term, because you are supposed to give us 10,000, but you gave us 8,000. 2,000 away. The 2,000 is lease prepayment. And so that will be recognized on the face of the financial statement, and then we'll be releasing it every year over the lease term. Okay? We release it every year over the lease term. Yeah. Every year over the lease term. The opposite is true. So let's say our fair value is 8,000. Oh, this is just something else. 15,000. But the lessor, the supposed buyer, gives us 25,000. Wow. Why would they do that? The fair value of the asset is 15,000, but they gave us 25,000. So they've given us an extra 10,000. That extra 10,000 is an additional liability. So that will be added to the present value of the minimum lease payment to prepare our amortized cost schedule for the lease obligation. So that is these are the two things that we must understand. Fair value 10,000, but we got 8,000. The balancing figure 2,000 will be dealt with at lease prepayment. And that will be recognized on the face of the financial statement and will be released every year over the lease term. But if the buyer, who in this case is going to be also the lessor, gives us more than the fair value of the asset, the extra is dealt with as an additional liability. Hence, it is added to the present value of the minimum lease payment and put in when we are calculating our amortized cost schedule for the lease obligation. These are the two things we must understand. Either we're going to receive more than the fair value or above the fair value. Like I said, if we receive the exact amount, there is no need for us to think about anything. We just ask ourselves, have we met the performance obligation rule? And then, boom, we do the treatment in that particular case. So these are the things that we must understand when we talk about the sale or lease back situation. What do I have? Yes, Candy, your hand is up.
Yeah, hello, Isha. Please, so the lease prepayment, the spread over, is it like you divide the 2,000 or is the same 2,000 that will be spread over?
I don't understand.
You say you will be carrying it on the face of the statements of financial position every year. So I want
Then
to find out
spread
if
it
every
over
year is
the
the
lease term.
2,000, the difference that will be carrying it, or you will divide.
I said the excess amount will be recognized as a lease prepayment on the face of the statement of financial position, and each year spread over the lease term. So if the lease term is 10, we divide that 2,000 over 10. And every year, 200 will be deducted and taken to the P&L account so that the carrying amount will be carried on the face of the statement of financial position. That's what we mean. You carry the excess on the face of the statement of financial position, and that will be spread over the lease term. So every year you release the annual amount into P&L accounts, then the carrying amount will be what we will carry on the face of the statement of financial position. So that is the idea about the prepayment. Okay, so these are some issues that we must understand. And for those of you who asked about the sale and lease back, that is the issue there. If there are any additional follow-up questions, those of you on Zoom, you can raise your hand and bring you up, or you can put it in the chat for me. Then those of you on YouTube who raised this, I think 2 people raised sale and lease back situation. If there are any other follow-up questions also, you can drop them as well in that case. So that's the idea about IFRS 16 leases. Then the last thing is going to be financial instruments. I mean, under financial instruments, we have 3 things there: financial asset, financial liability, and convertible loan notes. The rules are simple. When the entity is the one making the investment, the entity is the one acquiring, the entity is the one buying, the entity is the one purchasing, then we will recognize financial asset. But if the entity is the one issuing, the entity is the one selling, then we are going to be dealing with either an equity instrument or a debt instrument, that is financial liability. So these are the terminologies that we must know. So it's always important to understand whose books am I working. Am I working in the books of the one buying it or the one selling or issuing it? So if I'm in the books of the one buying it, financial asset. If I'm in the books of the one selling it or issuing, I could be dealing with an equity instrument or a financial liability. Now, how do we know that the investment is a financial asset, or sorry, a financial liability or an equity? We ask ourselves, does the entity have an obligation to repay? Does the entity have an obligation to repay? 2 answers can pop up. Yes, the entity has an obligation. No, the entity has no obligation. If the answer is no, the entity has no obligation, then that is an equity instrument. So if an entity issues a, a financial instrument, but they have no obligation to repay it, then it will be recognized as an equity instrument. But if the entity has an obligation to repay it, then it will be recognized as a financial liability. That's very, very important. Now, so how do we deal with this? You know that already. With financial assets, 2 things: either carried at fair value through P&L or at fair value through OCI. If it is carried at fair value through P&L, it means any transaction cost incurred in the acquisition or purchases will be written off in the P&L account, and any fair value gain or loss on subsequent measurement will also be recognized in the P&L account. However, if it is carried at fair value through OCI, then any transaction cost incurred will be included in the initial measurement of the financial asset. Then on subsequent measurement, any fair value gain or loss will be recognized in the OCI. So that is financial asset through P&L, financial asset through OCI. But sometimes an entity can buy a debt instrument. When an entity buys a debt instrument that is not traded on any stock exchange, then they will be carrying the debt instrument at the amortized cost. So in that case, what is going to be happening is that on subsequent measurement, the debt instrument will be carried at amortized cost, so that the effective interest rate becomes the interest income in the P&L account. The effective interest rate becomes the income in the P&L account. If it happens that we don't have effective interest rates, then the coupon rate becomes the investment income that we will recognize in the P&L account. Then we come to financial liability, which means the entity is issuing, the entity is selling, the entity is the one, making the offer. In that case, financial liability is recognized at fair value less transaction cost. So if we are in the books of the company issuing, we are in the books of the company selling, and it is a financial liability, then it is recognized at fair value it is recognized at fair value less transaction cost. So you shouldn't be confused. Nhyira, how do I deal with transaction cost? You don't ask that question. You have to find out, where are you? If you are in financial asset and the entity is carrying it at fair value through P&L, then transaction costs will be written off in the P&L account. If you are in financial asset and the entity is carrying the investment at fair value through OCI, then the transaction cost will be included in the initial measurement of the financial asset. But if you are in the financial liability, which means the entity is the one selling, the entity is the one issuing, then the financial cost or the transaction cost will be subtracted from the proceeds, the fair value of the proceeds we got, to get the initial measurement. That is the treatment of the transaction cost. And on subsequent measurement, we apply the amortized cost schedule for financial liabilities, so that the effective interest is what goes to the P&L account. The effective interest is what goes to the P&L account. The effective interest is what goes to the P&L account. So if for some reason we are dealing with adjustment and we are told that, oh, the entity has recognized the coupon rate as their finance cost, that's not what they are supposed to do. They are supposed to rather recognize the effective interest. So when we calculate the effective interest, there are two options. Either we'll remove all the coupon they have put there and bring in the effective, or we get the excess and come and add it back to their finance cost. That is how we deal with financial liability. Then the last thing is going to be issue of convertible loan notes. If the entity issues convertible loan note in accordance with IAS 39, that loan note has two components, a debt component and an equity component. So how do we go about it? The present value of the cash flows on the convertible loan notes discounted at the interest rate of similar bonds without conversion right, or discounted at the effective interest rate, will be the debt component, so that the difference between the proceeds and the debt component becomes the equity component. Number two, if the entity issuing the convertible loan note incurred any transaction cost, then the transaction cost will be shared or allocated between the debt component we have calculated and the equity component we have calculated and subtracted to arrive at the initial measurement. That is how we deal with convertible loan note. And on subsequent measurement, the debt component will be recognized at the amortized cost schedule, but the equity component will still be recognized at the initial measurement until the date of redemption or conversion. That is all about financial instruments. So, like I said, for these three guys, it depends on how excited the examiner is. One of them could be in the exam hall for us, or all three if the examiner gets goosebumps for us to deal with. Then certainly there are other accounting standards, IAS 10, IAS 2, and we've solved questions in respect of all of these standards. IAS 33, we've solved questions in respect of all of these standards. So the examiner can throw you whatever the heck he wants to throw you at, or he wants to throw at you. But that's what you must understand. The key takeaway is knowing that there'll be something on non-current assets. That's the first takeaway. Then the second takeaway is these three guys, all other things being equal, there is a 98% chance that one of them will be in the exam hall, these three guys. Or if the examiner gets goosebumps, he will find two of them or all the three somewhere being spread across in the exam hall because they are crucial aspects. Then for corporate reporting students, you have to know your exclusives, IAS 19 and IFRS 2 share-based payment. So that is our question 2 area, the accounting standards. Then we go to question 3. And for FR students, this is where we're going to have the single entity financial statement. That's for FR students. It depends. Either you do statement of profit or loss and statement of financial position, or you do cash flow statement. Whatever is it the examiner is going to bring to you, you are still going to be fighting with the accounting standards. So whether I like it or not, there is something about IAS 16 for you, financial reporting students. There is something about IAS 12 for you, income tax. Who pay, won't pay. You like it or you hate it, you're going to find it under the single entity financial statement, the question 3 part. Whether the examiner brings a cash flow statement, you're going to apply them, or statement of profit or loss and statement of financial position, you're going to apply them. So your best bet is to bet these two guys and know them very well. Then certainly other standards will be flowing in the note. Depending on how excited the examiner is, it could be a revenue standard, it could be a lease standard, it could be an error that they have recognized in the current year, in which case we are dealing with accounting policies, changes in accounting estimate and errors must be applied retrospectively. So you have to go and adjust the retained earnings for the current year and all of those things. So the accounting standards will still chase you down here when it comes to the single entity financial statement, and you're going to be finding yourself using some of the non-current asset standards as well as the key standards that I've mentioned here in that question 3 area for you when we are dealing with the issue about the single entity financial statement. For corporate reporting students, your question 3 CR, your question 3 will still be some standards and then possibly ethics. Some standards again and ethics, because the question 2 cannot handle all the standards the examiner wants to bring in. So sometimes in the question 3A, you still have a standard question coming up for 7 marks, also something like that. And then you're going to have an ethics question coming in as well. So the question 3 will still be standards and ethics coming in, and we've discussed the various issues about ethics. We did that on Friday, if you remember, so it's important you understand that very well. So up until this point, really you got to be strong in the accounting standards, and you know this already, right? So because in consolidation fair value adjustment, we are applying the standards. In question 2, dedicated accounting standards, we are applying the accounting standards. And then in question 3, the accounting standards are still following us here. So you got to be solid on the accounting standards. And at this point, I hope you're solid in the accounting standards as you prepare to go into the exam, or 9 a.m. tomorrow or 2 p.m. tomorrow in that regard. Then we come to question 4 here. For FR students, question 4, it's going to be on ratios, right? And for CR students, sometimes question 4 will be on either business valuation or corporate reconstruction, financial reorganization, with some theories coming up there on consolidation or something like that. If you remember, I gave you a blueprint on the way you interpret the ratios. I gave you a blueprint on the way you interpret the ratios. So, if you are interpreting profitability ratios, always start with revenue, asset turnover, come to net gross profit margin, cost of sales, and revenue. Then you come to net profit margin, revenue, cost of sales, operating profit. Then you come to ROCE, return on capital employed, revenue, cost of sales, operating profit, and changes in capital employed. So follow that guideline, because some of you, I don't know what comes over you, and you write whatever the heck you want to write, and you end up making contradictory statements. So follow this principle, and please, we said state the change. Okay, it's increasing or reducing, it is higher or lower. Then the other words you guys use, dropping and rising and all those kind of words you guys use, whatever it is, whatever. You state that. Then what are the possible reasons? Most of you, I think I've told you this over and over again, and some of you, I had a call with you yesterday and we had an interesting discussions about some of these things. Make sure that you are stating the reason why the ratio is changing. Don't just repeat or regurgitate the ratio that has been calculated. And the asset turnover and the ROCE and the net profit margin have all declined in the current year. So what? So what? Like what? Give a reason, and please make sure you are giving a reason in the context of the question. That is why I said revenue, asset turnover, how we are utilizing our capital employed in generation of our revenue, gross profit margin, the control the entity has on its cost of sales, net profit margin, revenue generation, control on cost of sales, and control on operating expenses. ROCE, revenue generation, control on cost of sales, control on operating expenses, and changes in capital employed. These are the context you use for the analysis. Okay, these are the context you use for the analysis, and that is very important. You come to liquidity ratios, the same thing. Don't just regurgitate. What does it mean? Yes, it is measuring the ability of the entity to pay short-term debt, not debt. Short-term debt as they fall due. Okay, so whatever that is happening, what does it mean? Can the entity pay its short-term debt as they fall due? Yes or no? You must state that explicitly in the analysis. Don't just say, liquidity ratio measures the ability of the entity to pay its short-term debt as they fall due. From the calculation, it can be seen that the current ratio has reduced. So what do you mean? Can the entity pay its short-term debt as they fall due? State it explicitly. Then you come to the efficiency ratios and all that. The same thing, right? Inventory turnover. Remember, when it comes to inventory management system, there are two ratios: inventory turnover period or inventory holding period, and inventory turnover. You have to use only one of them, and you must know the interpretation. If you're in the period or days, then we want the days to be shorter, which means we have an efficient management on our inventory controls. But if we're in the asset turnover, then we want the times to be higher, which means inventories are being sold faster and there is no lockup capital in the inventory of the organization. Note, only one of them can be used in analyzing the efficiency that the entity is putting in place on the management of its inventories. Trade receivables, trade payables. Don't just write them down, and the trade payable days has reduced, trade receivable days has increased, and so what? What's the implication of that? How do these connect to other ratios, the profitability ratios that you have connected? And please note, like I said, do not make any recommendation in the analysis, because your recommendations will come in the conclusion paragraph. And I'll get there in a sec. Then we come to the gearing ratios. Please note, gearing ratio is telling us about three things. One, the nature of the capital structure of the company. Two, the exposure of the entity to financial risk. And three, the ability of the entity to raise additional debt finance in the future. So when you are explaining the gearing ratio, don't just say, oh, the ratio indicates that the entity is not geared. Ain't okay? Ain't then? So what are you saying? What's the point? Okay, can the entity borrow additional money in the future? Is the entity's financial risk high? How much of the debt is the company of its total capital? These must be stated explicitly. That's how you explain the gearing. The nature of the capital structure of the company, number one, the exposure of the entity to financial risk, number two, and the ability of the entity to raise additional debt finance in the future, number three. These must be explicit. And note that the conclusion of these, the financial risk and whether the entity can borrow additional debt finance or take additional debt finance in the future, would depend on the interest cover ratio. So these are the guidelines. These are the things that you have to take into consideration. Remember, I've told you this. If there is anything we can guarantee on that we will be in the exam, or is evaluations. And so you have to understand the rules that governs evaluation. Then you come to your conclusion paragraph. Two things on the overall. Number one, what is the overall performance of the entity? And number two, what recommendations do you have? So all of the issues that you identified earlier in your analysis, now in your conclusion paragraph, you could make some recommendations as to what the entity must do. These are the idea about the analysis that we write. Please note, pro forma is going to be very important to the examiner. Give me a sec. So pro forma is going to be important to the examiner. So if it is a report, to, from, subject matter, date, intro, body, conclusion, close up. Thank you. Yours sincerely. Signature, name. If it is just analysis, heading, intro, body, thank you. Sorry, intro, body, conclusion, thank you. And we have said your intro is important. So your introduction should briefly explain what the heck the analysis is about. What is the basis of comparison? What is the year ended in the question? And the ratios you are using. Profitability, liquidity, gearing, whatever it is you are using in the context of the question. So these are the things you must understand about the analysis. And for those of you in the corporate reporting, we said the examiner may not go this way, the traditional way of ratio. You may have to evaluate the cash flow statement. And we've discussed the rules in respect of how cash flow analysis is done. And you have been given the guidelines about how we do cash flow analysis. So either the examiner will go that way for you for corporate reporting students, or you will go the traditional way where you have to do the calculation and interpret, or just write an interpretation there. So that is the ratio, either 15 marks or 20 marks. If the examiner wants to go 20, then the 5 marks will be a theory question, which will be on the importance of ratio analysis or the limitations of ratio analysis, or for you to just describe some of the ratios like profitability ratios, liquidity ratios, working capital ratios, or the gearing ratio. So we could have theories, 5 marks, coming in the exam hall about importance or objectives of ratio analysis and the limitations of ratio analysis. If the examiner wants to go 20, but if you just want to do 15, then either you calculate and interpret, or you are just going to do an interpretation for the whole 15 marks, in which case you have to be mindful of the analysis that you do. So that is evaluation of financial statements and the various things that you must understand. And like I mentioned, we have given you the blueprint and the various things that you have to be mindful of. Like I said, I think we have a lot of people calling, had a interesting session throughout yesterday with a lot of you guys. Be mindful of the things that I told you, and be mindful of the things that we did in class. Your grammar, your handwriting, your horrible presentation, and all of the bogus reasons that some of you were given, make sure this time around you are giving a valid reason. Don't make contradictory statements. That is very important, because this is a done deal. Just learn the blueprint, go to the exam hall, look at the ratios, and make sure you write your analysis to find in a manner that will enable you to get significant portion of the marks allocated. So that's about ratio analysis and the things that we need to understand. Then, like I said, corporate reporting students, business valuation, financial reconstruction, one of them will be there. Under business valuation, we've spoken about the principles, asset turnover, take note of everything in the notes over what is on the face of the statement of financial position. Asset valuation method, take note of everything in the additional information over what is on the face of the financial statement when you are doing the valuation, and any further adjustment that must be made. If we go to the PE ratio, you must know the PE ratio will come from a proxy firm. For that reason, we need to adjust downward in that particular case. If we are using earnings yield, dividend yield, we said we have to adjust upward to take into consideration the equity risk premium of the proxy firm's earnings yield or dividend yield ratio. So pay attention to all of those principles. But remember, the footnotes could cause us to adjust various figures. Maybe we would have to adjust the PATES, profit attributable to equity shareholders. Take into consideration if there is preference shareholders, we have to subtract the dividend to the preference shareholders from the profit for the year, so we can get our PATES and work with it. Then, if we are going to be dealing with the cash flow method, please note we are going to be applying the normal cash flow rule. Hence, we are always going to be dealing with the cash flow before depreciation. So if they have already deducted depreciation, we have to add it back. But if they have not deducted depreciation yet, we want the cash flow before depreciation, because depreciation is a non-cash item and hence will not affect the present value of the cash flows that we are going to use to value the business. But most importantly, if business valuation is going to come, note whether we are doing the valuation for the whole company or per share. Pay attention to the context of the question. Is it for the whole company or per share? That is going to be guiding you on how you do your calculation on the business valuation. If we are going with a corporate reconstruction, remember I've told you financial reorganization, for some reason, the examiner has not been really excited. It was just about 3 examination days ago that he brought a 5-mark question on financial reorganization. And that is a theory part where we are dealing with issues like, divestment, management buyout, management buy-in, sell-off, spin-off. Those theory issues, they are theory areas. The examiner has not really been excited about these things, but as we are ending the syllabus, maybe he could be excited in March 2024, tomorrow, I don't know. So make sure that in addition to those financial reconstruction calculations, you will read through the business reorganization part, because the examiner can throw some theories, because they are all theories there for you in the exam hall. But when you come to the financial reorganization, remember, you always, unless otherwise, as far as we are going to be implementing the scheme, you would have to prepare a capital reduction account. I've told you also, if the examiner asks you to calculate the maximum gain or loss on the scheme, it's the same as the capital reduction account, but this time around, at the end of the day, if we get a loss, which will be almost whatever, which will be almost what will happen, that loss will be shared between the preference shareholders and the equity shareholders. Again, read the question well for you to understand what is happening. But if it is just a normal reconstruction scheme we are dealing with, then we have to prepare the capital reduction account, which will be the to complete the double entry principle on the scheme that we are doing. Then, if we would have to do a liquidation before the scheme, then the liquidation rules, we get our proceeds from the liquidation. Please be mindful that if there is any cash outstanding on the face of the financial statement, when we are calculating the proceeds from liquidation, the cash in the statement of financial position must be added to it. Please be mindful of that, because if you miss it, then everything else is wrong. So be mindful. If we are going to liquidate, we will be told how much the assets will be liquidated for in the notes. When you bring all those proceeds up and there is cash and bank under current liabilities on the, under current asset on the face of the statement of financial position of the entity, that current assets, cash and bank will be added to the proceeds to get the total proceeds from disposal. Then after that, you can begin to do the sharing. Remember, if you get the proceeds wrong, everything is going to be wrong. So be careful. Be careful. So how do we do the schedule? You remember that if there is any liquidation expenses, it's going to go. If there are any priority payment, we bring it up. Then we pay secure debt. But for the secure debt, we first have to pay the fixed charge debt. What are the fixed charge debt? The fixed charge debt are the debts that are secured on specific assets of the company. And if you remember, the rule we established was that, hey, listen, if the fair value of the asset is less than the debt outstanding, then we'll pay up to the fair value of the asset first. The balancing figure will be treated as unsecured debt later on in the schedule. So we pay for fixed charge, we pay for floating charge, which means a debt that is backed by the whole company, not a specific asset. After all those schedule, if there is some money left, then we go to unsecured debts, pay for all that. If there is still some money left, we'll pay preference shares. If there is still some money left, that will go to the equity shareholders. But remember, I told you that if we are going to do the liquidation schedule, at the end of your schedule, you have to explain the status of the key stakeholders. How much are the bondholders getting? How much are preference shareholders getting? How much are equity shareholders getting? So that must be written specifically as a note after your calculation to explain what you have done. Then after that, if there is a scheme we have to undertake, then we may be required to prepare an extract statement of profit or loss. It depends on the context of the question. But as always, we will have to prepare a new statement of financial position, which will require you to prepare the capital reduction account to complete the double entry principles. So these are some of the things we have to understand also under the reconstruction scheme. Always pay attention to the context of the question. Read it very well. Read it very well and work as you read. I've told you this over and over again. Hold your breath and learn to interpret the things one after the other. Don't try to read the whole paragraph before you ask yourself, what the heck is the examiner saying? No. As you read, you interpret. As you read, you interpret. Learn to hold your breath. So that is the idea about the question 4-ish situation in that particular case, as well for the corporate reporting students in that regard, building up to question 5. Question 5 primarily for financial reporting student will be the theory area. Remember I told you that corporate reporting, financial reporting, we're going to have between 20 to 25 marks written questions. And these will cover issues such as the conceptual framework for general purpose financial statements. Number 2, accounting standards. So there's a theory about an accounting standard 5-mark question waiting for you in the exam hall. Which accounting standard? I don't know. When you get to the exam hall, you ask the examiner. Then there is going to be a theory question on consolidation. And so there are a couple of theories under consolidation that you must know about. How do we get control? What are the indicators of significant influence? When there is negative goodwill, how do we account for it? What are the things that the parent entity does when goodwill is negative? What must the parent entity do, and what are the reasons why an entity will have a negative goodwill in that case? So these are a couple of theories on consolidation. That one is 5 marks. Corporate reporting, financial reporting is waiting for you. So theories on consolidation. The examiner can also ask you, what's the difference between contingent consideration and deferred consideration, or any other thing in consolidation. So whether I like it or not, 5-mark question on consolidation theory is waiting for you. Whether I like it or not, 5-mark question on accounting standard is waiting for you. Corporate reporting student, financial reporting student, whether I like it or not, there is a 5-mark question waiting for you on the conceptual framework of the International Accounting Standard Board. 5-mark question. Whichever, what question is it? I don't know. You know. All right, you know. So when you get to the exam or the examiner will tell you. So these theories are going to be throwing up. Like I said, you're going to have between 2025 theory, corporate reporting, financial reporting, and these are the structure, or this is the structure of the examination and the key principles that we must understand when it comes to the examination. And I'm done with my discussion. Any questions for me specifically? Again, something specific that you would want me to talk about, or maybe you have a follow-up question on something that I said, you can raise your hand. I'll bring you up for those of you on Zoom, or you can put it in the chat also for me. Then if you're on YouTube also, you can put it in the chat for me and I'll be able to answer for you here. Then my final take is what I've already told you. So my recommendation is, number 1, read through all the questions. Read through all the 5 questions. 2, start with the theories and take them out as fast as possible. The theories that you can do. Between 20 to 25% theory will be in the exam hall. So start with them, take them out. Note, do not answer 2 different questions on the same page, but each different question must be answered on a fresh page. That's all you need. You are not under obligation to answer questions in any order. You are not under obligation to answer questions in any order, but make sure that questions are answered on fresh pages. Very important. So read all the questions, take out all the theories you can do as much as possible. Then from there, between ratios or evaluation, the standards, single entity, business reorganization, corporate reconstruction, read which one can you do best first, then you go in that order. Then, like I said, your consolidated financial statement question should be your last but one question. And at that point, all you are looking for is some easy marks. That is my recommendation for you. The reason why I said read through all the 5 questions and start with the theories first is because if you don't do that, I can guarantee you, and probably some of you have experienced this, after the exam, on your way home, you're going to flip through the questions. Or somebody will call you and ask you, how was the paper? Did you answer this question? And you realize that, there was a theory 10 marks question somewhere, or 50 marks theory question somewhere that you could have answered, but because you were hallucinating in the exam hall, you didn't see it. And there you start panicking, and you know you have failed the exam in advance. And so you start prophesying and you start attracting the failure, and the results will come and you fail. So read through all the questions, okay? And start with the written questions that you can answer best first. Take them out. Then between the standards, evaluation, business valuation, reconstruction, take them out. Then you go to the consolidation for some easy marks. But like I said, if you get to the exam hall and some delulu come over you and you say you want to do the consolidation first, I don't have a problem with you. You know your flow. Go for it. And we pray that you're going to do well on the overall at the end of the day. So that's my recommendation in respect of the way I want you to approach the questions. Note, the time will not be enough for you to answer all the questions. That's the reality. In as much as you're supposed to attempt all the questions, the truth of the matter is that 99.9% of you will not be able to answer all the questions. That is why you must read through all the questions, take out the written part you can do fast earlier, very early in the exam, then you continue with the ones you can do best in that order. And the strategy is to make sure you discipline yourself, allocate your time properly, and try your hands or attempt as many questions as possible. But the truth is, you may not be able to attempt all the 5 questions. It depends. If you are a good student and you work hard, you take out all the theories, God be on your side, all the written questions that will come, the ethics, the consolidation question, the conceptual framework question, the standard question, the theory question that will come. Maybe you know all of them and you take them out. That's 25%. Let's say you get 17 of that or 18 of that. Then you go to the other standards, business reorganization, do some things. Technically, you may be able to attempt only 4 questions within the 3 hours. Probably. And if you know what you did well, that should get you to be able to pass the examination. But don't be jumping from one question to another, because some of you are like, oh, I've done this one some more. Then you stop and go and do this one some more. When you do that, you're going to fail the exam. Because it's not about doing this one some more, doing this one some more. No, it's about which one can you do best first. Start with that and continue in that order. It's not about doing this one some more, doing this one some more. No. So for some of you, if you don't discipline yourself well, by the time you hear get ready to stop work, you have answered only 3 questions. Only 3. And there you know you may be failing the exam. So discipline yourself. Allocate time properly in the exam hall. That is why I said, take your time, read through all the 5 questions. The theory, because they are fresh in your brain, all other things being equal, when you enter the exam hall, you take them out as fast as possible. Then read through all the questions, like I said, then start with what you can do best first. So after the theories, if it is the evaluation you think you are strong in, go for it. If it is the standards that you think you are strong, the standards that they are asking for, they are simple, boom. Financial reporting students, the examiner 90% of the time will tell you which accounting standard you are applying. So you will see the standard there. But for corporate reporting students, the examiner may not tell you about the accounting standard. He will just say, advise the company how this should be accounted for in accordance with IFRS. So you're on your own. So when you read a story, you have to know, oh, this one is IAS 16 and IAS 37. Oh, this one is IAS 38 and this. Because you're on your own in corporate reporting. But in financial reporting, the examiner is a little bit generous, so he's going to tell you the accounting standard, which will then give you a clue about what you're supposed to do in terms of the principles in that particular case. So please learn to manage yourself psychologically, emotionally, your composure, your speed and accuracy, the way you punch, everything. Because yes, you can learn all you learn, but if you are slow, you are punching slowly, you are not reading the questions very well. Before you know it, get ready to stop work and you have answered only 2.5 questions or 3 questions. Then there you know you have failed the exam. Only that you cannot own it up and you cannot tell anybody about it. But you know you failed the exam. You know you have failed the exam. So keep your composure. Time will be your enemy. So to work, deal with that, that is what I'm saying. Read through all the questions. Take out all the written parts you can do best first, making sure you are answering each question on a fresh page. Then from there, look at the questions. Read all the questions. Then find out which one can I do best first in that order, in that order. Even if they say get ready to stop work and you have answered 4 questions and you did good in those 4 questions, that's over 80. If you did good, you should be able to get your pass mark from those 4 questions. Yes, attempt all questions, but you may not be able to do it because of time. And like I said, if you work with time and you really work in that order and you're a good student, solving 4 questions will still get you to be able to pass the exam if you did the right thing in those 4 questions. But if you just do one, then you pause. Go and do another, you pause. Another, you pause. With the agenda that, oh, I want to attempt all the 5 questions, you may end up getting 23 or 17 because you did not attempt and completed any of the questions fully. So that's just something, again, that I want you to be mindful of. So in addition to the principles that I've discussed with you, these are the things that I want you to take into consideration as you go into the exam hall. Please keep your sanity. It's very important. Don't look at the person on your right, on your left, before you, what the heck they are doing. Okay? Just focus on yourself, control your composure. If you start panicking, get some water, take a deep breath, practice breathing exercise to keep your mind insane. Because if you start panicking and you don't stop it in the next 60 seconds, your brain will freeze. And sometimes these are some of the things that causes people to fail the exam. It's not that they don't know. It's that they got to the exam hall, opened the paper, started reading, and they started panicking. And they couldn't control that. It's not the devil behind you. The devil doesn't know your address. You've not reached the level where the devil will come after you, with all due respect, okay? But you've not reached the level that the devil will come after you. It's not the devil. It's just your brain trying to misbehave. So just keep your composure, practice a breathing exercise, sip some water, and keep your mind sane and control yourself. You will be good. It's not the devil after you, because some of you spiritualize everything. And no. You have not reached the level that the devil have to come after you. The devil came after only few people: Adam and Eve, Job, and Jesus Christ. You've not reached the level of any of these people I've mentioned. So the devil is not after you. He doesn't even know you, that you exist. And your life is not consequential like that. Again, with all due respect, okay? But what I'm trying to say is, don't try to spiritualize things. Be sane, control your composure, practice your breathing exercise, and make sure you are reading and you are working in that manner. These are some of the things that I want you to understand about that. And I'm going to be wrapping up around here today because my time is like 9:40. I didn't know I would be going to 9:40 because I wanted to leave you guys very early. Any other things for me before I get excited and let you loose? Sir, please, can you explain the treatment for the contingent consideration and deferred consideration? I've already done that. Deferred consideration, you apply IAS 37, discount it into present value, and that is the present value you use in calculating the fair value of consideration transferred. Then for the post-acquisition period, you calculate the finance cost, and that will be taken to group retained earnings if we are preparing consolidated statement of financial position, or added to the finance cost if we are preparing consolidated profit or loss. Then that unwinding figure will also be added to the present value, and that will go on the face of the statement of financial position as the carrying amount of the deferred consideration. For contingent consideration, we said it is making additional future payment in the future payment, but that is dependent on the subsidiary meeting a certain condition. And so if we are not taking into consideration time value of money, then whatever figure is there, that is what we will use for the fair value of consideration transferred. And if at the reporting date there is a revision in the contingent consideration downward, then the difference will be treated as a gain in the consolidated P&L or group retained earnings if we are preparing consolidated statement of financial position. But if we are taking into consideration time value of money, then the contingent consideration will be treated like the deferred consideration. We discount it into present terms using the parent cost of capital, and then boom, we use the present value for the fair value of consideration transferred. Then we calculate unwinding of finance cost for the post-acquisition period, and it will be accounted for, treated in that manner. So that is what we mentioned. We have spoken about that earlier there. Okay, so if there are no other questions, then I'm gonna be signing off here. Let me see. On YouTube. Okay, I think there are no questions here, so I'm gonna go. You talked about some what? Distinction in answering ethics in CA. What is that? I don't understand what word that is. You talk about some distinction. What? In answering ethics in CA. I don't know what you're talking about there. Is it distinction in answering ethics? What's distinction? Ethics in audit and assurance is different from ethics in corporate reporting, and we have discussed this already. In corporate reporting, you are looking at what are the ethical issues and what is the threat and what should the accountant do to mitigate the threat. In auditing, the rules are different, so they are not the same thing at the end of the day. So I don't know the context of what you are asking, but in corporate reporting ethics, we have discussed and seen the way you are supposed to answer the question. You look at the threat that the accountant or whoever is in the question is exposed with. Then what fundamental code of ethics is the person breaching, and what should the person do to deal with the threat or to mitigate the threat? And we solved that question that we discussed in the mock. So, and that is different from ethics in audit and assurance, the way we are supposed to write the answers up. So if you understood the discussions of ethics in corporate reporting, it's far different from the discussion we did in advanced audit and assurance. So that is the idea there. Okay, so I think that will be all for today in that particular case. So we will leave you here and wish you all the best as you go in there in the exam hall. Like I said, make sure you focus and pay attention to the things that we have spoken about, because in the exam hall, you are just going to be applying principles. That's all. Principles. And I say this always. Some of you, I say this always. I said, yeah, it's not that you are wasting time, but some of you, you are learning in a way that it's not helpful. At this point, I mean, I've said this already. So, like, you are solving November 2023 or March 2023 or July 2023. Don't bother yourself. there is there is nothing there that will be valid for you in the exam hall. Nothing. Absolutely nothing. that will be there. That will be valued for you in the exam hall. Nothing. Again, like I said, it's not that when you are solving the past questions, you are wasting time. I've told you this over and over again. You better expose yourself to questions in the ICA question kits or questions from other sources. Because you are just, I don't know. I don't want to say it's wasting of time, but there is no scenario, no context that will be in the March 2024 in the past question. Nothing. Nothing. Yes, topics will be there, but the context of the question will not be the same. So you are better off looking at the ICA question bank, some questions there, or questions from other sources, rather than spending time and trying to solve from 1963 to 2023. Again, I mean, that's my take. And when I say some of these things, people don't get it, but that is the truth, because there is no scenario, no context, no nothing that'll be in the March 2024. Nothing. So you're better off looking at questions from other sources rather than trying to look at the past questions. When you look at the past questions, like I said, look at it in terms of, okay, question 1, this is what is going to be there. Question 2, this is what is going to be there. Question 3, this is what is going to be there. Okay, right. So what am I supposed to do? And that is the analysis that I've given you. If I'm in consolidation, what are the things I'm supposed to pay attention to? That's the things we discussed. Accounting standards. Which accounting standards are coming? Non-current accounting standards will be in the exam hall. So I have to understand the non-current asset accounting standards. Okay, ratios. What are the things I'm supposed to pay attention to, because ratios are going to be there? So if you're looking at November 2019, November 2023, July 2023, March 2023, I don't know why the heck you are doing that. Because nothing there, nothing. Nothing, no story there, no statements there, no context there will be valid for you in March 2024. I've told you this over and over again, but you know, some of you, as always, you like to go with your own flow, and you know, that's okay. So that's it. Enjoy the rest of your evening, and wish you all the best tomorrow, 9 a.m. financial reporting students, and 2 p.m. for corporate reporting students. Bye-bye. Tomorrow we're gonna meet for Tuesday's papers. I don't know what the heck is Tuesday. What do we have on Tuesday? Let's see. So tomorrow we'll meet for Tuesday's papers. Let me see. Tuesday will be MA and advanced audit. So tomorrow evening we'll meet to, you know, have the same discussion for management accounting and advanced audit on Tuesday. The same time, 7 p.m. So those of you doing these papers, I'll be catching you tomorrow, 7 p.m. And let's see what we can do for MA and advanced audit as well. Au revoir and all the best. Bye-bye.